Okay, hi everyone. Thank you for tuning in today. I'm Carrie Enright Cato, Director of the Office of Climate Change Technology and Research at Connecticut Deep. Welcome to the Exploring Climate Solutions webinar series. The series is brought to you by the Governor's Council on Climate Change. On April 22nd, 2015, Governor Malloy issued an executive order creating the Governor's Council on Climate Change, also known as the GC3. The Council is charged with examining the efficacy of existing policies and regulations designed to reduce greenhouse gas emissions and identify new strategy to meet the state's greenhouse gas emission reduction targets. The Council is composed of 15 members from state agencies, quasi-state agencies, businesses, and nonprofits. To learn more about the GC3, please go to www.ct.gov/DEEP/GC3. The webinar series explores innovative and successful climate change solutions in Connecticut and the nation, and the series provides first-hand accounts of high-profile municipal climate programs, climate initiatives in the corporate world, new greenhouse gas reporting frameworks, statewide sustainability programs, low-carbon fuel initiatives, and other programs and projects that help reduce greenhouse gas emissions and improve climate resilience. Today, we're excited to have Jeffrey Schub, Executive Director of the Coalition for Green Capital, and Bryan Garcia, President and CEO of the Connecticut Green Bank. Jeffrey will provide us with an overview of the Green Bank movement at the national level, and Bryan will focus on Connecticut Green Bank's initiatives. Green banks provide low-cost, long-term financing support to clean, low-carbon projects by leveraging public funds through the use of financial mechanisms to attract private investment. Their presentation will be about 40 minutes long, and then we'll open it up for questions from the audience. If you do have a question, please submit your question in the question dialog box, and we'll read it out loud for Bryan and Jeff to respond to. Before we get started, for those of you listening via your computer speakers, and if you're experiencing poor sound quality, I do encourage you to call in using your telephone. So with that, Bryan and Jeff, thank you again for your willingness to present today. I'll go ahead and turn it over to Jeff to start.
Thank you so much, and thank you so much for the opportunity to speak with you all this morning. Always excited to speak with folks in Connecticut and others around the country who might be joining to talk about green banks. Connecticut is in many ways the birthplace and the greatest success story of the concept of green banks. All credit due to Bryan and his amazing staff at the Connecticut Green Bank. So really excited to be able to talk a little bit about the overall green bank concept, the objective of green banks, how they work, and give a little bit of the landscape of green bank activity around the country before handing it over to Bryan to talk a little bit more in detail about the activity actually in Connecticut through his organization. Just a little bit of background, my organization, the Coalition for Green Capital, has been working on the topic of green banks since 2009. We're a nonprofit organization with offices in DC and New York City, and our objective is to accelerate the deployment of renewable energy and clean energy solutions as quickly as possible to avoid climate catastrophe, recognizing that finance is an essential component of that. So green banks aim to provide financing for clean energy solutions through public-private partnerships that use limited public dollars to drive more private investment while creating a broader demand for clean energy solutions. We're a little bit of a hybrid of an advocacy and advisory and consulting firm. We are working in about 15 states or so across the country, working at the federal level, as well as internationally at the topic of green banks and public-private partnership financing for clean energy, because it's ever more important globally as we come out of Paris and nations look to actually satisfy the pretty immense promises we've just made around climate emissions reductions. So as I said, first I'll give a little bit of an intro to the concept of green banks, then we'll talk through some examples and lessons learned from around the country, and finally some trends and observations as well as some new federal activity that's really exciting that's happening right now. So why do green banks need to exist? Why do we need public or quasi-public finance institutions to invest in clean energy when there are obviously many other industries that don't have that kind of support? Well, when it comes to climate change, a lot of the clean energy technologies that have been developed that are economically viable and can reduce energy costs as well as reduce CO2 emissions happen to be in the form of distributed, smaller technologies and distributed projects, which are typically harder to finance. If we think about the traditional energy grid and power grid, we're talking about really, really large centralized generation projects. These are, quote, utility scale projects like a coal plant or a nuclear plant or a natural gas plant. These are hundreds of millions of dollars or billion-dollar projects, and they have some significant benefits that allow private capital to flow into this segment of the market fairly easily. One is that all the power that is produced from a power plant like that is bought or either immediately owned by a utility, and utilities have really strong credit ratings. So if a bank is considering making a loan to build a power plant, they know that the person on the other end of the transaction that's going to be buying the power will be paying back that loan. If they know that that's a utility with a really high credit rating, then they're much more likely to make that loan. These projects also just look very similar to lots of other kinds of big infrastructure financing, and so the scale, the simplicity, and the credit make it fairly easy to finance. Unfortunately, almost none of these attributes are true for many forms of clean energy. If we think about building efficiency or distributed solar generation, these projects are much smaller, so inherently these are less cost effective for many banks to underwrite because the process of underwriting and assessing the credit quality is a matter of man hours, and it's a somewhat fixed cost, variable, but it's somewhat fixed. So if the size of the investment is smaller but your cost of underwriting stays the same, banks are inherently less attracted to investing in that market. These projects also have scattered locations, there are different technologies. One efficiency project is very different from another, and the credit varies a lot. Every homeowner, every building owner, sometimes it's actually hard to figure out whose credit is actually on the line for certain kinds of clean energy projects. So, and there's also a kind of a complex list and a range of types of structures that are used to finance projects, all of which adds up to much slower flow of private capital going into the space than is necessary, much slower, in fact. And finally, one of the big differences between kind of old energy sources and new energy sources is simply a lack of track record and lack of history. There is a lot of data to show banks and investors what the default rates are, what the performance records are of certain fossil fuel-based projects, but that is definitely not the case in the clean energy space, and so that lack of data is a real barrier to private investment. So green banks are designed to fill these financing gaps and draw in the capital needed to make clean energy markets grow. And they do this in two different ways. They both are a source of financing and a driver of private investment, and I'll explain that more in detail. But they also work to grow demand for clean energy. This has been an important kind of lesson learned over the last decade or so in the space, is that making capital available on its own is not a solution. It does not drive significant market growth because nobody is simply out there looking to finance clean energy. They need to actually want to have the clean energy in the first place, and then financing is the solution that makes it possible. And if we're talking about distributed generation, which is typically the case of what we're discussing in a state like Connecticut, we might be talking about a rooftop solar system that costs $25,000. Just like a car, if there was no such thing as a car loan or a lease, very few people would own cars because very few people can just take $25,000 out of their pocket and plunk it down on the table at the point of purchase. That is why financing exists, and that is why financing for clean energy is so critical. The same reason that if you can adopt clean energy for zero money down and pay it back over time out of the savings that are accrued through the clean energy that you've adopted, you've created a very, very attractive value proposition. But again, that value proposition has to be delivered in conjunction with a whole host of demand-generating activities, including greater information, just general awareness, peer-to-peer marketing, greater transparency on prices. Bryan and the Connecticut Green Bank have really been excellent at this activity. So it's about pairing the financing activity with the market development, and that's the role that green banks play. They play this role of both driving investment and creating a more robust and efficient market. Structurally, what does a green bank actually look like? This is a little bit of a simplification, but it's generally true across the states that have green banks. A government would decide we want to create an institution. They might not actually call it a green bank. It's not always called a green bank because sometimes that term has some political challenges to it. But they would create an institution that it could be directly part of government, it could be a quasi-public, as in the case of Connecticut, and then the government would put public dollars into that green bank to seed it as an investment fund. The green bank would then make investments directly into projects in partnership with private investors. The green bank it's not giving a subsidy, it is a loan, it is a finance mechanism. So it is being paid back on the terms that it requires, and the private investors are being paid back on the terms that it requires. So the green bank is leveraging more private investment using public dollars. So the public dollars are not only being preserved because they're offering finance rather than subsidies, but the public dollars are being used in a way that tries to drive as much private investment per public dollar as possible. As I've described here, a lot of the green banks are trying to address two different market needs. On the financing, it's filling market gaps. This is an important point here, that there are parts of the clean energy space that are adequately financed. If you have a credit score over 680 and you live in the right state and your roof faces the right way, you can get on-demand financing for rooftop solar from companies like SolarCity. It turns out that there are a lot of people that don't fit into that category, so there are pretty robust and large market gaps. In addition to filling gaps, as I said, green banks are looking to stimulate private capital and leverage public dollars as much as possible. And on the demand side, everything that a green bank delivers has to have an eye towards demand. It has to be thought through from the beginning of how do we actually ensure that these financing solutions are delivered in a, quote, turnkey fashion where the barriers to adoption and the ease of adoption the ease of adoption is incredibly high. Green banks offer a really wide range and can offer a wide range of actual finance tools. Many governments today actually do offer or may offer some form of financing support for clean energy. A lot of states have revolving loan funds. They might have a credit enhancement program. The difference between those and a green bank is that a green bank is literally an institution that has the capital and the flexibility in the balance sheet to offer a whole range of financing solutions. So a green bank could have a loan product for solar and a credit enhancement product for commercial building efficiency. It could play a warehousing role for multifamily low-income projects. So you can see this menu as an opportunity for green banks to kind of mix and match financial structures with markets to serve the specific market needs of every state. And as we've learned by working across the country, there are a lot of challenges that are similar from state to state, but the exact market needs and the conditions in every state vary pretty dramatically. For a host of reasons, energy is unbelievably state and locally controlled and regulated, so things vary from state to state, and so green banks have to vary from state to state. I want to note these finance mechanisms that are on here. People might be familiar with the concepts of on-bill financing, or PACE. PACE stands for Property Assessed Clean Energy Financing. PACE is a construct whereby a building owner could receive a loan for a building upgrade, for an energy upgrade to the building, and then pay that loan back through a tax assessment placed on the building. So just like your property taxes, you would repay that loan through your municipality. And on-bill financing is similar, except rather than through your property taxes, you repay the loan through your utility bill. These are really innovative, clever constructs that create security in lending for what otherwise looks like an unsecured loan. These mechanisms can be implemented without a green bank, but they're also really well structured to work with a green bank. Both PACE and on-bill require two things to work. They require an administrator who's willing to actually put in the man hours to set up and administer what can be a fairly complex structure. And they need capital. There needs to actually be loan capital that's going to go through those structures to finance the projects. And again, green banks can either provide that capital directly, as in the case of Connecticut with their PACE program, or provide a credit enhancement to drive private investors who might be on the edge of investing. And as I described before, the ideal structure for green bank financing is one where a customer is saving money month to month on their bill. So we can imagine a situation where a person is paying their utility bill, and then they get a, let's say it's an energy efficiency upgrade where their utility bill drops dramatically. This is stylized, but the structure of this is true. And then they have the financing repayment that has to be repaid to their lender, whether it's a green bank or a private investor. But you end up with the savings because the net combination of financing and the remaining utility bill is less than what you were paying before. And so this is what we would call net cash flow positive, where the borrower is saving money on clean energy, on their energy costs from day one. They put no money down and they immediately start saving in month one. This is what is required to actually drive demand, but this also requires financing that is patient and reasonably priced. If the interest rate is too high or the term of a loan is too short, this equation doesn't add up and this green block is much, much higher. And so much of what green banks are trying to do is extend the term of financing in partnership with the private sector and lower that cost of capital. This is one example. This is a sort of model on one of the products that Connecticut Green Bank offers, where a green bank could offer a loan loss reserve product to a number of commercial banks that encourages those banks to make loans at lower terms and better terms than they would have otherwise, and thereby creating a whole network of banks that weren't participating in this market before, but now because of this credit enhancement are willing to operate in the market, learn about how the cash flows work, how the projects work, understand what the true risk profile of these loans are, and then ultimately be willing to operate in this space without the support of a green bank credit enhancement. The benefits of green banks I think are pretty numerous. You're able to build your economy on clean energy because more financing, more demand means more jobs for contractors, and these jobs have to be local. You can't outsource energy efficiency installations. And for the lending community, green banks are opening up profitable investment opportunities. These are markets that have potential, like enormous potential market size, like billions and billions of dollars of potential investment in Connecticut alone, for example, that are left untapped. And so green banks help private investors move into this space, find profitable investment opportunities, and do it with a little bit of a safety net as they start moving into the market. Let's talk about a couple of the examples around the country. This map shows the states that have existing green banks, which are in green, as well as states that are at some stage of development and consideration for green banks. So California, Connecticut, New York, Rhode Island, Hawaii all have green banks, or things that are green banks that don't have that name necessarily. Rhode Island's green bank is called the Rhode Island Infrastructure Bank, where they've paired clean energy investment with water and infrastructure investment, which is really clever. And not on here also is New Jersey. New Jersey has an energy resilience bank, which in many ways is modeled on the green bank concept of driving private investment, but it's focused on increasing energy resilience at critical infrastructure like water and wastewater treatment facilities. But all of these other states here are at some level of green bank development. And again, none of the models are the same. Every state has to build a green bank to fit their own needs. Some of them are directly part of government, quasi-public. Actually not shown up here is Montgomery County, Maryland, is the first county-level green bank that's been created in the country. And theirs is actually an independent 501c3 nonprofit that's taken a really innovative structure to make it work for their conditions. There are actually even more states than this that are at some level of discussion, but these are the ones that are kind of actively pursuing this concept as we speak. And then broadly around the world, this is not just a U.S. phenomenon. The UK and the Australian national green banks are multi-billion-dollar investment funds that have leveraged tens of billions of dollars, so over $10 billion. And I believe Bryan is going to talk about this, but all of these green banks now are starting to be much better coordinated and communicate more through a brand new global green bank network that our organization is working on with Bryan and a number of these green banks around the world, in partnership with the Natural Resources Defense Council to try to solidify and better structure mechanisms for information sharing among green banks around the world. I think I'm going to skip over this, but for those that are interested in understanding a little bit more of the details of the structures and the landscape in the different states that have green banks, there's a few slides here that talk about kind of what each state saw in front of it and why it chose to use the model that it did. I'll give a quick example. Connecticut's Green Bank is quasi-public. New York Green Bank is directly part of its state energy office. The reason for this was based on desires for expediency in creating the Green Bank, legal allowances that already existed within the New York State Energy Authority. They are, however, both funded through the same mechanism where they are both taking a small piece of the existing system benefit charge that collects money from ratepayers and putting that onto their balance sheet on an ongoing basis. And we talk a little bit more about Rhode Island and Montgomery County, Maryland here as well. A couple of the key lessons learned from green banks, these institutions are fairly new, but we have learned a lot of lessons. It's really critical for green banks to be comfortable trying new things, measuring their success, and adjusting. Experimentation and being okay with failure is essential to learning because green banks are meant to be flexible, quickly moving institutions that respond to the market conditions that they see, and therefore you have to be willing to move quickly and experiment. Green banks are most successful when they use the entire toolbox of products and services that I showed on that sheet before. This is a complex and really varied market. There is not one solution that fits every form of clean energy. So green banks should be comfortable experimenting and trying different kinds of tools. And again, you can't make one solution work for every market, which means you have to be really targeted in what you're trying to achieve and which markets you're going after. We've seen a lot of examples of failure from existing finance products that were created under the stimulus program in 2009, where a state energy office might create a just generic revolving loan fund for any kind of clean energy for any market. And it turns out that by creating something for everybody, you sort of created something for nobody because each market has its specific needs. And then finally, you have to think about demand. You have to design products for ease of use and thinking through the entire chain of how a product actually gets to a customer. You have to think about how is this product actually going to be used by a private lender, how is a contractor going to then use that product to deliver it to the customer, and how is the customer going to respond and react and actually ultimately sign up to use that product to adopt clean energy. You can't just offer capital, you have to think about all of these elements. More detail of what all of these elements are here. There's a lot of elements of what green banks need to do to build the market. Everything from advertising to offering the financing to thinking about contractor training. Not all of this has to be done by a green bank, but it has to be thought through in a comprehensive way to create an actually robust ecosystem for a green bank market, for a clean energy market to grow. Then finally, some trends. This is not just a blue state phenomenon. Green banks are a really nonpartisan concept. They've received bipartisan support at the federal level in Connecticut and a number of states, and a lot of purplish and red states are now engaged in green bank discussions. Again, demand, demand, demand. States all recognize this now. You have to focus on the demand for clean energy, not just offering the financing. Over the last year or so, I'd say the entire clean energy industry and nation has woken up to the reality that clean energy has to be made available and affordable and accessible to everybody, and this includes low-income populations. The Connecticut Green Bank has taken a great leadership role on this for the spectacular product that Bryan might talk about. But the needs of the low to moderate income community are, in many ways, are different than the products that are out there today to support clean energy adoption. And so tailored solutions are needed for the segment of the market. The federal government does support green banks. They've done it in a number of ways by trying to make existing funding mechanisms available for state-level green banks. President Obama has spoken positively of the Connecticut Green Bank. This is a concept that they're starting to put weight behind. And there is a global recognition of the role of green banks after Paris, not only through the creation of this green bank network, but broadly speaking, there's been this kind of collective awakening after Paris of everyone was thinking like, oh my God, how do we actually achieve what we just promised? How are we going to pay for this? And very quickly, a lot of international NGOs and nations are turning towards public-private partnership constructs. And then the very last thing I want to talk about on the U.S. federal level, which is really exciting, is that just last week, federal green bank legislation was reintroduced, trying to basically take the Connecticut model nationwide. Green Bank legislation was originally introduced back in 2009. This was kind of before the Connecticut Green Bank was created. This was the very beginning efforts of green banks. It had a lot of bipartisan support and passed the House of Representatives, but unfortunately was tangled up in cap and trade and so died on the Senate floor. The original proponent of this bill, Representative Chris Van Hollen from Maryland and Senator Chris Murphy from Connecticut, are now sponsoring this reintroduced bill, the Green Bank Act of 2016, with a couple of key changes from the last version of this bill. When originally conceived, the National Green Bank would effectively be like the Connecticut Green Bank, just at the federal level, directly financing projects around the country using public-private partnerships. But over time, the sponsors of this bill and leaders in the space have recognized that state and local government is really where it's at when it comes to making wise investments and policy decisions around clean energy. And so the new federal Green Bank legislation calls for the creation of effectively a pass-through mechanism, an entity that would exist to identify and designate eligible state and local green banks who would then receive federal funds to capitalize their own institutions. And from my own experience, I can tell you this is exactly what is needed, as many, many states find interest and value in creating a green bank, and then the number one obstacle and number one question is, where is the money going to come from? Not all states have the financial resources that came through the Connecticut System Benefit Charge or the immense political leadership that Governor Malloy had in creating a green bank. So having a federal mechanism to support local state and local green bank creation will be really, really valuable. I think both sponsors of this bill recognize that nothing is happening in 2016, not just on clean energy, but on anything at the congressional level. But the hope is that by planting the seed in 2017, this can be revisited for a truly legitimate consideration for passage. And with that, I thank you all so much for the opportunity to speak with you, and we're excited to hand it over to Bryan to hear more about Connecticut.
Great, thank you, Jeff. So I think we're going to get started here with the presentation hookup over here. So Carrie's going to send me a quick note, and we should be ready to go.
And you should have received the notification.
Share my screen. Here we are. Uh-oh. Forgive me, Carrie. I am trying to share my screen here. Are you sending me over something? There we are. Perfect.
Great.
Okay. All right. I think it's perfect. Thank you. Thanks for your patience there. So it's great to be here partnering with Jeff on this presentation. It's also great to be, a part of the Governor's Climate Change Council and supporting all the work that Carrie and Jeff are doing to help us all figure out how we're going to attack these aggressive 2050 greenhouse gas emission reduction targets. So it's exciting to be a part of this webinar series. So let me just follow on Jeff's comments a bit and talk a little bit about a green bank in application. So I'll provide some history in terms of the Connecticut Green Bank. We'll go through, Jeff talked a lot about the structure of products and programs. I'll give some examples of what we're doing here in Connecticut. And then lastly, we'll kind of wrap up with, okay, so what's being achieved with this model and kind of what's next in terms of the Connecticut Green Bank. So let's start off with what's the Green Bank. So as Jeff alluded to, so it started actually back in July of 2011 with the passage of Public Act 1180, bipartisan supported bill. This is actually the piece of legislation that created the Department of Energy and Environmental Protection. There was a section of that bill, Section 99, that repurposed an existing organization, the Connecticut Clean Energy Fund, into what was then called the Clean Energy Finance and Investment Authority. It was later renamed in 2014 to the Connecticut Green Bank. But the focus of the governor at the time was to try to move clean energy beyond just being a niche product, trying to mainstream this technology. And the way to do that was going to be by leveraging limited public funds to attract multiples of private capital investment in Connecticut's clean energy economy. So I'll go through a couple of programs that we have that are in fact doing that. I think conceptually, when you think about what we're trying to do with this public-private partnership model, is that over time we're trying to reduce the market reliance on public resources by attracting more and more private capital investment into the state's economy. With that, we will see more deployment of clean energy, and as a result, we'll create jobs and will lower greenhouse gas emissions. So hypothetically, this is what the Green Bank model is trying to achieve and what we are doing here in Connecticut. So let's jump into the programs and products of the Connecticut Green Bank. So just starting off here high level, so Jeff talked a lot about the need to return investments. That's definitely part of the Green Bank toolkit. Here in Connecticut, we administer an incentive program, so I just want to talk a little bit about applying the Green Bank philosophy to an incentive program. And then we're going to go into other structures for how we've partnered with private sector entities to bring in more investment to make clean energy more affordable and accessible to consumers, some of the things we're doing on credit support with local community banks and credit unions, and some of the larger investment transactions where we're actually standardizing new loan underwriting processes. In Connecticut has to do with PACE, commercial property assessed clean energy, and how we're selling off transactions, allowing us to recover funds and reinvest those in the state economy. So let me start off with an incentive program real quickly. So this is just a look at residential solar PV in Connecticut since 2004. Our role here in Connecticut is to provide incentives to consumers through a declining block structure. So the goal here being trying to reduce the market's reliance on the need for incentives to create deployment of clean energy. What you can see here with the bars essentially represent installed costs for clean energy. The dark green portion of the bar represents what the customer is paying at the end of the day. Also included in that is the 30% investment tax credit. The light green portion of the bar represents what the state has been providing through incentives to customers over time. So what you can see since we launched this residential solar investment program in 2012 is, the market doing very well in terms of doubling year on year. The incentives have decreased by 80% since 2012. Installed costs have also come down by 35%. So the industry's been doing very well in terms of building businesses based on volume as opposed to profit margin. So all the local Connecticut installers doing a great job here, making, again, clean energy accessible to consumers. So over the course of this last 5-year period since 2012, nearly $600 million has been invested into residential solar, of which about $90 million of that has come through incentives through the Connecticut Green Bank, deploying nearly 140 megawatts of solar PV systems. So today we are providing a very low incentive and seeing more and more residential customers installing solar PV. To build off some of the comments that Jeff was alluding to on the demand side, so we're going to talk about some financing products that we put into the market to make solar PV more accessible and affordable to consumers, but we also had to be a stimulant to the market, to be a catalyst to creating more and more demand. So we learned from Portland, Oregon, Massachusetts. They were implementing Solarize campaigns. We saw in Connecticut, given all the great work being done by the clean energy communities, that this program model of a Solarize can work in Connecticut. So we piloted it in 2013, and you can see the results of our first 4 towns. These graphs are essentially the cumulative amount of solar PV being deployed in these 4 towns. And what you see in 2013 is this dramatic shift in demand. The Solarize program is very unique in lowering costs. The more and more people who sign up and want to install solar, everybody benefits from it. So it creates a community dynamic and a significant demand creation. What's interesting is that if you look at the tails, and forgive me, I don't have them on here, but what happens after the Solarize campaigns is the markets don't revert back to the same growth rate. They actually continue to have a more accelerated growth rate than what they were before the Solarize campaign. So these sorts of things can be catalysts to creating a market and then sustaining and growing it over time. So we learned that through these sorts of campaigns, you can get more and more consumer demand and access to some of the financing programs. So I'm going to go through a couple of products just to give you all a sense for how we think about the world and structuring products that attract more private investment. The first one is the CT Solar loan. So we work with a company called SunGage Financial. They submitted a proposal in an RFP that we issued back in 2012. They recognized that their solar PV costs were coming down, and that even though the lease model was doing well in the marketplace, that installed costs were going to come down so much that the value of solar PV was going to be better if a consumer took out a loan. So we ended up partnering with SunGage to develop a standardized loan product. The product actually re-amortized the federal ITC, so after the first 18 months, if the homeowner put in 80% of the value of the ITC that they received, the loan would re-amortize. If they didn't, the loan interest rate actually would increase. So there was an incentive for them to apply the ITC to the loan. We ended up issuing about $5 million worth of paper through this program. So we were sitting on that. That was on our balance sheet as repaying loan assets. Well, we wanted to be able to recover those funds and reinvest them in other programs. So we ended up going to the crowd, and in fact, in 2014, we ended up selling $1 million worth of Connecticut paper to residents in California through the Solar Mosaic platform. We've been talking a lot about trying to bring crowdfunding to Connecticut. It requires a lot of detailed policy work, but California was the market at the time, so we were able to sell some of the paper in California. What's been great is that over time, SunGage graduated from our product here in Connecticut to a partnership with a regional, actually a national credit union, the Digital Federal Credit Union, who said, you know, we like this asset class that's been created on solar. We understand the risks. We don't need the credit enhancement from the Connecticut Green Bank. So we are willing to commit to providing up to $100 million of financing for these sorts of loans. We're going to not only offer a 15-year loan at 6.49% interest rate, but we're going to give the customer a 10-year and a 20-year term as well to give them more choice. And we also want you, SunGage, to offer this product in other states in the region and across the country. So for us, this was perfect. This was actually the first graduation of a Green Bank program where a new asset class is created, and we can go on and move on to something else. So SunGage is doing great things in providing access to loan financing across the country. But one of the things that we recognized at the end of 2014 was there was a policy objective of delivering no less than 30 megawatts of residential solar by the year 2022, and we were getting close to hitting that target. Is our board asked us to take a look at how we were reaching the low to moderate income census tracts with solar PV. We worked with UConn to do a study, and what we realized was that we were doing a really poor job of reaching the low income market segment, and that we needed to focus our efforts on being a catalyst to making solar available to this market segment. So while the rest of the market was moving and working, we redirected our efforts to focusing on providing financing products, and I'll talk about one here in a second. What's been great is that we've made some progress over the course of the last year, year and a half. Those numbers below the arrows here are what the disparity was in 2014. So we've cut them in half, and we're going to keep chipping away at this because we want to ensure that the clean energy economy is for everybody. So that led us to issuing an RFP to try to find somebody in the market that was willing to serve the low to moderate income space. We ended up finding PosiGen, a company out of Louisiana. They were actually born out of Hurricane Katrina, the reconstruction of New Orleans. They wanted to ensure that homes had access to renewable resources. we were able to attract them up to Connecticut. They established a beachhead in Bridgeport. They've expanded to New Haven. They're now in the greater Hartford area. And they've got a really interesting model for the low to moderate income space. They don't underwrite based on credit. They have other underwriting capabilities that they underwrite to, but what they provide is a lease product to a homeowner, and they also give the homeowner an option to upgrade and do more energy efficiency through an energy savings agreement. So these numbers here are they're exemplary numbers that we talked about with our board, just to give an example of what we're trying to do in the low-income spaces to lower the energy burden on low to moderate income households. So in general, you can imagine that the lower income households are spending more of their household income on energy than non-low to moderate income households. So what we are effectively doing with the PosiGen product is lowering the energy burden for low to moderate income households to a level that's on par with non-low to moderate income households. So we do that with a combination of a solar PV lease and an energy savings agreement where the household can, this says $15, it's actually a $10 ESA. So they will pay $10 a month for a 20-year period, just like the lease. And that $10 per month allows PosiGen to do upfront about $2,000 to $2,500 worth of energy efficiency work. So they'll go into a home, they'll work with the Home Energy Solutions program, they'll do the audit, they will then go in and do some insulation, weatherization, and so forth. So this is a great product. We've seen, and this is what we're seeing, right? So you can see neighborhoods now. This is in Bridgeport, where homeowners are taking advantage of solar PV and doing the efficiency programs, and we're confronting this problem. A second example of a product is the Smarty Loan, the third example, credit support. So this is where we're actually providing a second loss guarantee to local community banks and credit unions. So this is what we call our comprehensive energy strategy product. The CES has a number of clean energy energy conservation measures that it's trying to support, from renewable energy to energy efficiency to, EV recharging stations, gas conversions, you name it. This is a product where a homeowner can take out a low-interest long-term loan from a local lender to support those measures. And what we do is we provide a second loss to the local community banks and credit unions with the thought that once they understand the risks in this space, they will see that there are very low defaults, that they could lend more money into this space at lower costs. We currently have one default out of $12 million of origination here for this product. So again, in the next couple of years, we expect some of these local lenders to say, we don't need that state credit enhancement. We think there's a business here. We'll keep lending into this market. And then lastly on the product, so warehousing, this is the last example. So here in Connecticut, we are the national model of commercial property assessed clean energy. We have a number of municipalities who have opted in to open their market up to private investment in clean energy. As you can see on the right side there, total capital invested when we started with CPACE implementation in 2013, we were using 100% of our own funds. In fact, these were repurposed RGGI funds from energy efficiency and renewable energy. We went out, we created a standardized underwriting process and documentation that the capital markets would be willing to buy these transactions from us. So we were experimenting using RGGI funds. We then, I'll talk about our first securitization in a second, but what you can see over time is that we're gradually reducing the level of our participation in the capital structure and bringing in more private investment. A number of different sizes of projects through CPACE, very small projects, boiler conversions, all the way to a large, very deep projects of large commercial office buildings, all different types of properties being done through CPACE. So just getting to the warehouse structure, so you can imagine a number of different end users, from small manufacturers to farmers to we figured out how to apply PACE to nonprofits to help them provide financing for those energy improvements. We created this standardized underwriting process that we were able to package all of these things as loans or benefit assessments, and we sold them into the market through bonds, and we're able to recover 80% of our funds back through clean funds. So this was the first securitization of a PACE product. It received a lot of national attention and really demonstrated to the financial community that there was a market for PACE paper in the commercial space, which ultimately led to, in December of last year, Hannon Armstrong saying to us, we're willing to commit $100 million of our capital to you, the Connecticut Green Bank, to loan out 4 C-PACE projects. You put out $1, we will put out $9. So we've been able to increase our leverage, again, starting at 100% public funds to now 10% public funds, providing more investment into the market. So those are a couple of products and things, products and programs that we have out into the market now, just what's been achieved. So we've just completed our 5th year in the market since the policy passed in July of 2011. We are approaching $1 billion of capital mobilized in our economy. You can see here the level of investment, the level of clean energy deployment, the leverage ratios that we're achieving, and we're doing it with the expectation of getting the money back. So we're putting it out, and we're going to get it back over time. So to the point that Jeff was raising earlier, there's an urgency behind the climate problem. There's an urgency in terms of the need to create jobs. Green banks can help accelerate the pace of clean energy deployment to create jobs and confront climate change. Our board just approved of a comprehensive plan today. We will make that available to folks as a follow-up from this webinar. We are, through our reporting, we do a comprehensive annual financial report. This is the gold standard for government reporting. We did our first one in fiscal year 2014. So not only do we have our audited financial statements put out there, but also we report all the non-financial statistics, the societal benefits that are coming with more clean energy deployment here in the state of Connecticut. We have community fact sheets, program fact sheets, a really cool document if folks are interested in data and reporting. Our board also approved today an evaluation framework going forward, and we are working on a data collection and analysis protocol for the organization as well. And just to wrap it up, there was a study done by the Center for American Progress that said that the U.S. needs at least $200 billion a year annually in renewable energy and energy efficiency investments to avert climate disaster here in the U.S. Jeff and his team at Coalition for Green Capital, working with his partners at NRDC, did a calculation based on Connecticut's performance over the last 5 years and said if we continue on this trajectory and every state had a green bank operating like the Connecticut Green Bank, then we would be able to achieve that $200 billion target in national annual investment within a 5-year period. So a small state like Connecticut can have a very big impact globally on the climate problem. Which leads us lastly to the Green Bank Network. We are a partner with Jeff, the Coalition for Green Capital, and the Natural Resources Defense Council, which are coordinating the Green Bank Network. We work very closely with our partners in New York, UK, Australia, Japan, Malaysia, and this is an organization where we can exchange best practices, go a little bit deeper in terms of what we're doing, and try to see if there are any replicable models going on out there. So I think that's it. We're excited. Everybody's doing great things out here in the communities of Connecticut. Keep doing what you're doing. We need to do more, so we're not going to slow down, but it is an exciting space to be in, and I want to thank Carrie and Jeff again for giving us the opportunity to talk about green banks.
Great. Thank you, Brian and Jeff. That was really informative, a lot of great information. So I'll go ahead and open it up to questions from the audience. If you have questions, please submit them via the dialog box. I guess the first question is, are all banks seeing investments in green energy as an opportunity, and how has this interest evolved over the last 5 to 10 years? I guess that goes to either one of you if you want to take a stab at that.
Jeff, let me take a local stab at it. In one of the structures, I didn't show it, is a lease, the Connecticut Solar Lease structure. We actually involved First Niagara Bank and Webster Bank in that structure. It's a $60 million fund. They provided senior debt in it. U.S. Bank provided $23 million of tax equity. The local banks provided $27 million of debt. That fund, we just completed that fund. they are now investing in other projects because of this. It's enabled them to understand the risks of clean energy. Webster Bank has now created a division. Carolyn Morrison's doing great, trying to identify clean energy investment opportunities not only in Connecticut but across the region. First Niagara is starting to delve into a number of other renewable energy technologies. So for us, that's a complete win. You know, we're working to de-risk the perception that investing in clean energy projects is risky, with the hope that the private sector would step in and continue to be a partner and support the industry.
Okay, we have another question, actually a follow-up question here at Connecticut Deep from Ben McMahon.
Hi. At some point, do you feel that there will not be a need for public funding, or do you have a time frame or a goal for a reduction in the level of public funding needed?
So great question. Let me take a stab at it, and Jeff, you can provide a national perspective. I think there's definitely a goal of reducing the market reliance on the need for subsidies. There are a number of clean energy markets, though, right? So I gave an example of the residential solar PV space where you can see applying the Green Bank model is trying to achieve that. We can completely see a future where hopefully the customer is connected to, say, the Class 1 RPS, and there's not an intermediary. That would be a great future to be in, as well as not even having to need, you know, an RPS down the road. So that's definitely a goal, but then there are other market segments that open up, right? So the low to moderate income space, or other technologies. You know, we are working with Carrie and Jeff and the GC3. One of the things we recognize is that if we're not attacking the transportation industry or how we heat our buildings, then we're never going to hit our greenhouse gas emission reduction targets. So how do we apply the Green Bank model to opening up and being a catalyst to some of these other markets is what we're focusing on as well.
Yeah, and I'd add just kind of at a conceptual level, it's definitely an objective to reduce the reliance on public dollars over time. I can't say that there is a specific rate or pace of that reduction or a timeline. But the belief, or not even belief, the fact of it is that clean energy should be a very attractive investment for private investors because the projects pay for themselves, meaning they naturally generate the revenue to repay loans. And for certain types of investors who are interested in a long-term horizon for returns, like pension funds or insurance companies, they really, really match the profile of what they're looking for. So there's nothing about this sector that inherently requires private investment. It's very much about fixing a market inefficiency and a market failure where private capital isn't moving into this space yet. And ultimately, given the scale of the amount of global investment needed that Bryan alluded to, there is just no way to achieve that without primary reliance on the private sector. So the more quickly we get private sector capital into the space, the more quickly public dollars can be used for things that really do require public dollars, like maybe traditional infrastructure investment, like roads and highways.
Great, thank you. We have one more question. If you're in the audience and you'd like to get a question in, go ahead and do it now. This last question is about the PosiGen product. Is it available for those who rent or for multifamily units? And if not, how do you have plans to address this sector?
Great question. So the LMI market is one of the most challenging markets for our team to figure out, and that's why the board prioritized it for us. So PosiGen addresses the single-family owner-occupied market space. We have a number of other initiatives, and maybe what we can do, Carrie, is I will send a link to our multifamily products. We partner with the Connecticut Housing and Finance Authority, the Department of Housing, and the utilities around the multifamily units. For example, we've applied that Solarize model with Chaffa properties, and we see the same impact and same effect through multifamily. But the products are, you know, a bit different. We've got the MacArthur Foundation, which has put in a program-related investment here in Connecticut, $5 million, 1% interest, 15 years. to help us figure out how we're going to crack the nut on this market space. You can imagine that these homes have a number of challenges, health and safety issues. So we're trying to figure out how to address those as well alongside the energy burden measures that we're trying to address. But I'll make sure we can get out a link to show you what other products we have out there.
Okay, we did have one more question come in, but I might need some clarification. Are there plans to apply the model to large or commercial green clean energy projects? The PosiGen model, or I need a little bit more clarification on what model?
I mean, I guess, so I can try to interpret what the question, I think what the question is asking is, have green banks thought about financing things like utility scale wind or solar projects possibly? You know, big, huge wind farms, for instance. To date, I don't think any green banks have done projects like that for the simple reason that many of those projects today can get reasonably priced financing in the private sector without the help of a green bank. There are, billions of dollars invested in these projects across the country without public support beyond the existing federal tax credits. So primarily that's one of the reasons why state green banks haven't invested in that space. Another reason is that those projects are just huge and green banks don't have that much funding. If they invested in one project like that, it might take up all of the dollars in the bank. So just from a kind of diversification standpoint, it hasn't happened. We can certainly imagine getting to a point, maybe not necessarily like Connecticut, but in parts of the middle of the country where there are, where the, quote, best wind sites have been taken up, but there are plenty of other wind sites that would produce economically viable power if their cost of capital were lowered by a few percentage points. And we have models that have shown how this works. So you can imagine green banks addressing some of those, second best sites for wind or solar farther down the road.
I guess the only other thing I would add to that would be on the capitalization side, we're starting to look at the issuance of green bonds. So one could envision down the road potentially partnering with other regional and or large projects in the state to provide access to lower cost capital. So we're starting to think about those things, and to the extent we can make green bonds available to Connecticut citizens, just like our crowdfunded product of loans in California, we look forward to trying to offer green bonds to our local citizens on a level that is affordable. I don't know, $500 par value bonds and so forth. But stay tuned for the issuance of our first green bonds in the upcoming fiscal year.
Great. I'm glad you guys she wrote in and said yes. That's exactly the question that she was looking to be answered. One last follow-up question on the PosiGen program. Bryan, you said that they didn't use traditional methods for providing credit to low income. Can you elaborate a little bit more on what they look for in order to provide that credit?
Yeah, so I will do a follow-up and just give you a couple of bullet points on some of the different things that they use to underwrite. It would be things like utility bill repayment history, things like that. But I will send along a few points. My team is more in the details on that different underwrite. So they don't underwrite to FICO. They don't underwrite to debt to income. They have other metrics that they underwrite to. And I'll get those.
Thank you. So that's all the questions. Thanks for a wonderful webinar and, again, a lot of really valuable information. We will have this recorded for folks to view or send around to other people who have missed it. It will be on our website either later today or early Monday morning. And we are lining up a webinar for August. We'll send out a notification of when and what that will be, so stay tuned. Have a great afternoon, everyone, and thanks for tuning in. And thanks again to Jeff and Bryan.
Thanks so much.
Thank you.